Hey, it's Jeff Garber, mortgage expert, mortgage interest rate guru. Want to give you an update on what's going on with mortgage rates for this week. So let me get myself out of the way here. Perfect. So what you are looking at, if this is the first time you're watching one of my videos, is you're looking at the bond market trading live right now. More specifically, you're looking at a chart of mortgage bonds or mortgage-backed securities. And based on the way these mortgage bonds trade, well, this is where lenders come up with their rate sheets. And all you really need to know is red is a bad day, green is a good day. We're always looking for green candlesticks because green drives the price up. And when the price goes up in the bond market, well, rate or yield comes down. So we want to see a lot of green candlesticks, and we want to see a pattern that we're starting to see now that shows a continuation of green candlesticks and a continuation of possibly some improvement of mortgage rates. One of our biggest questions that we get is, how high are we going to get? Did we peak? Well, we're going to watch closely now because it looks like we're starting to level out and get into what's called a sideways trading pattern where we we kind of break free of this downward trend that we've been in since January, and we kind of get stuck in a trading range that kind of goes up or down within that trading range. And we would welcome that because that would eliminate a lot of the volatility that we're seeing, although this trading range that we're looking at here is a pretty big trading range. So if we get stuck in a range where the bond wants to go up and down in this big range, well, that could still be a movement of about 0.25% or so of interest rates for the better or for worse as bonds go up or down. We'd like to see the trading range narrow a little bit and maybe get comfortable for a little while so that we can relax and let this play out. What I mean by let this play out is we're battling inflation right now. And inflation, as I say every week, is the kryptonite to the bond market, more specifically mortgage rates. So if inflation is high, like it is now, mortgage rates are going to be higher. And that's exactly what you've seen happen since the beginning of the year. We had a significant increase in rates because inflation just started to get hotter and hotter. And now that we have the Federal Reserve finally stepping in, although late to the game, they are stepping in. And it's their job now to get ahead of inflation. Well, how do they do that? Well, they raise what are called short-term interest rates, not long-term. So many times, every 6 weeks when the Fed meets and they raise short-term rates, everybody goes into a panic saying mortgage rates just went up. That is not true. In fact, oftentimes, mortgage rates can go the other direction. Maybe not in the beginning of a Fed hike cycle. We've had 2 so far. We're going to have several more. But as the Fed hikes short-term rates, they're doing so to make things more expensive, and in so doing, have inflation possibly come down. And in every other cycle that we've seen where the Fed gets into a hiking pattern that they're in, we've seen inflation come down and we've seen mortgage rates come down with it. So we're expecting to see that same pattern sometime over the next 6, 12, 18 months. Very hard to predict when, but at least right now for the short term, it looks like rates have found a home. We'll see if that can hold. Rates, you could say are around 5.2, 5.3. That is not a rate quote. As I say every week, if you would like a rate quote, you need to speak to a professional that is able to give you an official rate quote. And for now, I'm using these numbers just as an average, just so that from week to week, we can kind of see what's been going on. So the good news is we're in a nice little trend here for the last 4 or 5 days where the bond market is doing well, unfortunately, at the expense of the stock market. And look, a lot of this is tied together. Stocks and bonds typically have an opposite reaction. And when the stock market sells off, typically investors are fearful. They take their money out of the stock market and they put it in the bond market where there's a little bit more safety. And when they put money in the bond market, some of it goes into these mortgages that you're seeing, and that drives the price up. And when price goes up, rate comes down. And so regarding the stock market, we're starting to get close to correction phases and even possibly recession. So we want to keep an eye on what's going on in the stock market and keep an eye on what's going on in the bond market. Keep an eye on inflation, because as inflation comes down, mortgage rates can come down. So far, good news from this week to last week, or I should say from last week to this week. So far, I like what we're seeing. If we can start a new pattern here and break out for sure, if we're 100% sure that we're going to break out of this horrible downward trend that we've seen for a long time now, that could be good news for interest rates. That will calm a lot of people down, maybe get some people off the sidelines and into the housing market, because there is still affordability when rates are in the fives. We've seen it before and we see it right now. So if you are considering getting pre-approved, but you're intimidated possibly because of rates being a little higher than they were, I would say go get pre-approved. A pre-approval is free. You will learn a lot about your current financial situation and your affordability, and you might be surprised that you still can afford exactly what you were looking for. So go get pre-approved, and I'll catch up with you next week.